Hello and welcome to episode 7 of Curly's Trade and Blueprint. In this episode, we're going to go over premium and discount and then order blocks. These are the last confluences we need to learn in our trading. We've gone over fair value gap, inversion, SMT, liquidity sweep, and now we're going over order blocks and premium and discount. These are everything I use for trades. So once you know them 6 confluences off by heart, you know all the confluences we're going to use in our trading. Let's get into premium and discount and start there. We're going to need this tool here, the fib retracement tool. I did tell you to set it up in the candlestick video. If you haven't watched that, go back. In the second half of that video, we went through setting up your trading view. When I pull it down, it should look like this. If it doesn't, you need to make it look like that. As I've said, I showed it in the video. Here we start at the top, so it's 1, 0 0.50. Doesn't make a difference if 0 is at the top, 0.5 or 1. It's the exact same range, it's the exact same points. So we will put that on the top of a move. Let's say price went up, pushed all the way up here. So this is the full move up from the downside to the upside right there. We would put our Fibonacci tool at the bottom of the move. And at the top of the move, I'm going to go on the charts and show you the example, but I want to show this example without using the candlesticks first. Then, as you can see, we're looking for a pullback. So what does a pullback mean? When we mark at the top of it here, the top of the move, we might get a little pullback here, then we might go up a bit because candles don't just move up and down a straight line. We have bits and bumps and we're going all around the place. When this happens here, then we can look for a trade here. Now, what are we seeing here? Price started down here, moved all the way up to the 1. So we put the 1 where we start moving down, so the very top of a move. As you can see, we pull back, go up a little bit, and pull back down into 0.5 of the range. Under the 0.5 to the downside is called discount. This is called the discount area, and this is called premium. Now, you can probably already guess what we're going to be looking for. But when we're looking to take short positions, we're looking for price to tap into the premium area and go down. When we're looking to take long positions, we can look for discount of the range. So the range is the high to the low of a move. As you can see, this is a bullish example. So we're looking for price to come into the discount area. As you can see, we come under the 0.5 right here. That is our discount area. So, you probably guessed it. That is where we can look for maybe an inversion fair value gap in an area like this. And then we can look at to take a trade maybe from a level like here back up to this high here. Does that make sense? We're looking to take long positions from discount and flip the other way. We'd be looking to take short positions from premium. And we can expect price then to push back on. And that is very simply premium and discount explained very, very simply. I am going to go on the charts, but that is how we identify and use them on our charts. Getting into a bullish example right here. As you can see, I'm putting my 0 at the bottom of the move right there. I'm putting my 1 at the top of the move right there. And as you can see, this is the 0.5 area. You can't see it, but that's 0.5 as we've marked out. This on the 15-minute time frame. This can be used on all time frames from the 1 minute to the 4 hour. Whatever it is, we can use 50% of the range. When we see here, it's also lined up with a fair value gap that we've talked about before is an area price can reverse off. This makes this even better, this level, this 0.5, as it's lined up with a fair value gap we could reject and go back to the upside to take a trade. When we look at what price happens here, as you can see, we have it at the top of the move. So I wouldn't be putting my tool on until we start again a pullback. So when we start coming back down here, I put my tool because price could go higher. So you'd have to extend it if it went higher. Does that make sense? But in this example, we stopped here with the move up and we started to pull down. Again, this would be the key area I'm looking for. Because this was the start of our move up. As you can see, we came up, we came down, we went all the way up. This is our big range we've been using. And as you can see, price ends up tapping into our level, and then we get price slows down, but then we get our reaction out of it, as you can see right there. Right there, we get a reaction out of it. We actually, in this example here, get an inversion fair value gap as well. So, what could you take? You might be able to take this position here, something like this. This could just be a trade example. Using our swing high we talked about, remember this is swing high, like we talked about in our last video, as a break-even level. When you let price play out, you would have hit TP on this position. As you can see, you would have never been break-even and you would have hit TP. And that is very simply how you line up discount in this example. If it's a bearish example, it's going to be premium. I'm going to show you that next. But that is how you put it all together. Put your inversion fair value gap together. Put also, oh, we moved that. Put our inversion fair value gap together. Put our fair value gap top together. Put our discount and premium together to take a winning position. Hope that makes sense. We also have our drawn liquidity here, which is a swing high in this example. And that's why we were looking to take that long position back to the upside. That is how we put three confluences together and a drawn liquidity to take a winning position here. We might even have SMT. I don't have ES open to check right now. Now, here is a bearish example. So, what is this area up here called? Premium. This is the best place for price to tap into when we get our pullbacks and then we go back down. We're looking to take short positions, bearish positions from premium. When I look here, this was the move down we started. So we obviously put in this swing high, a big push to the downside as you can see right here, and put in this low right about there. As you can see, price comes up, nearly hit the level, didn't, went back down, didn't make the range any bigger. As you can see, it didn't sweep this low, went back up, and then when we hit the 0.5, we actually get a downward candle. And what does it do? It ends up inversing a few gaps, ends up inversing a fair value gap right here. This is just an example of a position. It inverses a fair value gap right there with that leg down there. It also inverses one right here, as you can see, all on the 15-minute time frame. So these are all areas you might have been able to take position from. As I've said, I don't know what's happening with ES, so I can't say what I've took this position. But if you did, there you go. There's one winning trade. If you use the lower one here, you also would have hit TP as well on this position. You probably would have moved your stop loss a little bit tighter, but there's loads of winning positions to take from this move down for us to catch trades back to the downside from our premium level above the 0.5 in this example. We have been using discount because NASDAQ is normally trending to the upside. Obviously, NASDAQ normally goes up in price every year, same as ES. That's why they're safe investments to keep going up. That's why we're normally using our discount levels, but we also use premium nearly just as much to take short positions back to the downside. And that is very simply what discount and premium are. There's not much more to them. Mark out your range. Your range is the swing high to the swing low you've been using of the big range. There's loads of different options. You can use obviously lower time frame positions. I have been showing 15-minute as they are better, and the higher the time frame, the more power it has in the market compared to the 1 minute. And that is how we use premium for price to tap into and deliver lower. If you look here, we also ended up tapping into a fair value gap right there as well. So discount or premium was in line with a fair value gap and we rejected off it. And you can see how we line up our fair value gaps with the premium level in this example. I showed the discount before with the premium level to take position. So then you have two confluence, a fair value gap tap and premium of the range to take short positions back down with your inversion fair value gaps. Now, this is order blocks. If I'm being 100% honest, this is my least used confluence, but it's good to know just so you know it. I normally do not take trades from order blocks. It's not my favorite confluence, but I'm going to teach it to you just so you know it and have it when you can backtest your own strategy. I'm going to show you at the end of the blueprint. When we get into it here, basically an order block is an engulfing candle after liquidity sweep. That's what I look an order block as. So we had a liquidity sweep, as you can see right here, to the downside. We don't necessarily need liquidity sweep in every position for an order block, but I prefer it, and I prefer when we use it so it adds and doesn't confuse or not marking out loads of order blocks on our chart. I stick to, in my opinion, the higher probability ones, which is the ones after sweeps on liquidity. What is an order block? This is very simply our order block right here. It's this box here. As you can see, the candle comes up, sweeps the high, comes back down. So I will mark out the body of that candle. So right here is the box of the body of that candle. Would you agree? I'm marking out the body of the candle that swept the high. As you can see right here, price reacts off it and goes back to the downside, engulfing this candle. So that means, obviously, Price closed right here. When I take away the drawings, price closed right here. This candle opened and we close in this bearish example below the bottom of the candle close of the candle that swept the high. That's a bit techie. I'll say it one more time. We open here, as you know, with candles, and we engulf, we close below the body, in this example, of the bullish candle that swept the high. Then we draw out our box where the candle before, so the candle that swept, we draw out the box of it, and that is our order block that we can look for price to reject off, or we can use as a place to put our stop loss if we're looking to take maybe a short position. We can cover the order block as another confluence for price to go down. In this example here, as you can see, if I draw this across, as you can see, price tapped in the order block, rejected back off it, back to the downside here. We obviously didn't end up pushing down much lower, but we still got a reaction off this level, off this order block. So it worked to push price lower, and eventually, as you can see, the order block ended up breaking, and we end up going higher in the day or in a few days later, whatever time frame you're using. And that is very simply how we use order blocks to take trades. Price can bounce off these levels. As I said, it's not my favorite confluence to use. I don't love it in my trade, and I use it mostly as stop loss placement. So when I'm taking a trade like here, I'll cover the order block maybe on this position, and I can target maybe the low down here as a TP level. And that is how I use order blocks in my trade. In this example here, a bullish one, I've gone for a smaller example. As you can see, we have this body close this candle here. We obviously engulf it. As I've talked about, this is a bullish example. As you can see, price taps into the order block right there and pushes back to the upside. So this is the position I did show earlier. So you can use the order block to cover your stop loss on this position, or you can put it at this low here that tapped in the order block to go higher. Back test that and find out for yourself. For me, I would put it on the wick here, as that's called a protected low because it's tapped in the order block and pushed us higher. So price, in my opinion, should not come back down that level before it takes out this high. And as you would have seen, we would have hit TP on this position as I showed in the premium trade. So now we've added another confluence to this winning trade I showed, an order block tap as well to the upside. And that is order blocks. Obviously, we went through premium and discount. They are the most important ones out of this episode, in my opinion. Go look at order blocks, see how price reacts off it, see how it pushes back to the downside, and how you can use it for stop loss placement for bullish and bearish examples. Definitely go and practice premium and discount because they are key confluence, as you can see, to our strategy. When we make a range, they are the areas we can look to take trades from. Go and back test them in your trading. Go have a look at order blocks, see how price reacts off them to the upside and downside. You might see success with them in your trading. For me, I prefer using them, as I've said, as stop loss placement. And that is going to be it. The next episode, we are still on the chart, so make sure you tune in for that in 2 or 3 days. I'll see you on the next episode of Curly's Trading Blueprint. Peace out.